Vetri Subramaniam is with us, Chief Investment Officer at UTI Asset Management Company. Vetri, good morning. Good to have you with us here. Thanks very much for your time. Is it all clear, Vetri? And we are again, markets are snapping back. Stocks are snapping back 20, 30, 40% very quickly. And you're right back to where valuations were. And valuations were a problem, right? When we were talking about it a month ago, 2 months ago, etc. What's your sense, Vetri?
I think one round of the panic to whatever developments were happening on the tariff front and the worries about, how long the uncertainty might persist. One round of panic, I think, related to the market has played out. My sense is that the longer term ramifications are still, sort of unclear. The good news from an Indian perspective, really, so to speak, is that we know that, our exports to GDP in terms of the first order impact, in terms of the export of goods, is only 2% of GDP, right? So there's only a limited extent to which the US, tariff war has a direct impact on India. But obviously, we have to worry about second order impacts. And good to remember that second order impacts can both be opportunities as well as challenges, because, if people are not able to export into certain geographies, will they try to dump elsewhere, so on and so forth. And at the same time, if tariffs are higher on certain other countries, it could be an opportunity for Indian companies. But I think really all that's happened is that we've gone more into a holding pattern right now. It's very hard for me or for anybody to claim that they have complete certainty about what's going to play out. And I worry that it's really that uncertainty which will continue to weigh down on the market at this point of time.
Okay. So uncertainties and lack of clarity, that continues. Vetri, good morning. Great to have you on. But, what I think a lot of people are pleasantly surprised with is the momentum that the market has found on the upside. And that's thanks to the flows, right? Every day we measure those numbers, count those numbers. 2,000 crores, 3,000 crores coming in from the FPIs. Let's talk about financials, because they're directly benefiting from this return of the FPIs. And you've been very, very positive on financials, even when they weren't doing anything in the market. But how much of the good news is in the price? Do you expect a bigger growth kicker ahead? The numbers are looking pristine, no problems there. But what next?
Sure, Surbhi. The only point I will make, Surbhi, is that for 30 years, I've been seeing daily numbers of FPI and DII being reported, and I stopped looking at it 30 years ago because I figured that for long-term investment, who's buying and who's selling is really the most useless piece of information you can look at. So that's not what really drives my thought process. And again, in terms of FPI buying and financials, that's not the way I would look at it. I think what we need to keep in mind is that we had a monetary environment along with a fiscal environment which was very tight, very conservative for the last 2 years. I think particularly on the monetary side, the interbank liquidity being negative meant that credit creation was being held back. You also had, maybe rightly so, the RBI making multiple interventions, raising risk weights, trying to sort of caution the banks from growing credit. And I think all of that contributed to a sort of managed slowdown of credit growth in the economy. You look at the year ended March 31st, credit growth in the economy is just about 11%, which is pretty much most likely 150 basis points higher than where nominal GDP growth is. That's a very weak pro-growth impulse from credit. I think one of the changes that I'm seeing in the last 2 months is really that RBI is now waking up to the fact that perhaps there is a need to put a little bit of growth impetus back in the economy. They are doing it through administrative measures. You've seen that even on the, sort of LCR ratio changes that they recently announced. They're allowing interbank liquidity to go positive. And I think we are perhaps now in an environment where credit growth can actually become supportive of economic growth. What do I mean by that? If you've got economic growth running in terms of nominal terms at 10% or thereabouts, you could actually be in an environment where credit could be running at 13 or 14% for the system as a whole, also because it would then sort of support growth within the economy. And to the extent that we are facing, external headwinds, I think one of the levers available to us to support the domestic economy is credit growth, and the banks are in good shape. We know that company balance sheets are in good shape. Households, little bit of stress, but I do hope that the household balance sheets would have seen some healing because of this fabulous rise in gold prices. The Indian households are over-indexed on gold, but it's certainly healing their balance sheets.
So, Vetri, just to follow up on that, you're saying 13 to 14% credit growth system-wide. I'm not sure if that happens this year itself or not. In terms of multiple expansion, in the heydays, we've seen banks trade at 4-5 times price to book, NBFCs trade at 8-9 times price to book. Let's talk about the larger banks. I think most of them are still around 2.5% to 2.8 times PB. What is the valuation expansion in this leg of the financial run that you would anticipate?
Yes, Surabhi, my thought process is that a year ago, even when we spoke about this, I was talking about the fact that valuations were very, very comfortable. In fact, they were perhaps even cheap because, people were looking at the adverse news flow. And, my sentiment at that point was they are cheap because you're looking at the adverse news flow, not at what is possible. I think we are now in a phase where perhaps the market and, at least as investors, we should be looking at the fact that I think there is a scope for credit growth to surprise on the upside over the next 2 to 3 years. And I think as a result of that, you can get a combination of both earnings compounding and some improvement in valuations. Those numbers that you talked about in terms of price to book that we've seen for specific financial institutions in the past are not a benchmark. That's certainly not the number that I would be working with in my head. But is there scope for margin expansion? There certainly is. And I would also argue that, in this kind of environment, many of the banks, not all of them, many of the financial companies will be able to grow without diluting because at their current level of ROA, they can easily sustain 13-14% credit growth without seeing any rundown in their capital adequacy ratios. So it's a sweet spot for them where they don't need to raise equity money to actually, deliver balance sheet growth. And therefore, it's very self-sustaining in terms of the outcomes that you can experience as an investor.
Hi, Vetri. Good morning. Good to see you. When I recall in Feb as well, we had a chat, right? At that point of time, you said BFSI, that's your sector that you like. It's going through a bit of a knock, but you said that that's one of the top sectors. And the other one you mentioned, I think, was the power stocks. Post the pullback, you said that maybe some of them look interesting. Are both those two still, we've already discussed banking. What about the power stocks?
I think power is a little bit more tricky because at the end of the day, it is a utility business and therefore you've got to be cautious about what you're willing to pay for it. And I just think there are many moving parts over there in terms of everything that's happening, particularly in terms of the new energy and the solar piece. But I think in India, increasingly, we will find that a lot of our requirements in terms of powering the grid for growth over the next decade will come from traditional fuel sources. And I think there are a bunch of, local companies which are well placed. Also, you will have, interestingly, I think some opportunities in the transmission side, because the more complex the grid gets in terms of the sources of power, actually, it's the transmission companies which also start to benefit from that. So I think power is something I'd stay reasonably positive and constructive. But remember, it's eventually a utility. Returns are regulated, and there is a scope for policy intervention in multiple manners.
Vetri, just thinking ahead a little bit, do you think, right now we're in a bit of coming off very beaten down levels and there is generally a bit of a risk on, but with regards to India, all commentary, etc., seems to suggest that we are first in line for a deal. But even then, there is wide acknowledgement that it will take time. I mean, it's going to be many months away, right, for a final comprehensive deal. Do you think, as we get closer to the 4th of July, I think 4th or 6th of July, which is a 90-day cutoff, 90-day pause, say after another 20 days, if there's nothing which is moving forward, once again we will enter that period of uncertainty and people will start to question what happens, etc., etc.?
Without doubt, Prashant. But I think we need to step back for a moment. Forget the uncertainty that perhaps people who are trying to day trade the markets are facing, or even we are obviously dealing with very uncertain events. But think about what's happening to the economy. You've got businesses going on hold because they really don't know how their supply chains are going to behave. They don't know how long they will be able to hold their price line. They don't know in which geography and where they should be making investments to build their new factories. And if they take those decisions, they don't know whether they have the certainty of policy. So really, I think the bigger concern is, markets can keep repricing things instantaneously. But I think the bigger damage which is happening to decisions being made by businesses, by industrials, by industries, and eventually some of that flow through to consumer. And that is what would trouble me because, when I look at the Nifty consensus earnings growth of 13-14% for FY26, that is not a low bar. It doesn't sound like a high number, but in an environment of uncertainty where everybody is going to be cautious about building that next new factory, consumers are going to be worried about, hey, what's the outlook for my industry? What's the outlook for my income? Should I be buying a car? Should I be buying a house? Should I be putting money down on something? There is a scope for things to slow down. And it's that earnings concern that I think I would worry about a little bit more. And the simple way in which the market tends to deal with earnings uncertainty is pushing the multiple down for earnings. So I would still in that sense say that, don't go by, okay, the market's sorted because it's up today. Don't go by everything is busted because market is down today. We are in an environment of uncertainty and you need to build that into your investment strategy.
You preempted my next question, Vetri. I'm so glad you brought up that point. So, X of the US issues, let's leave that behind. I mean, assuming for a second that we get a deal and it doesn't all, go to hell, so to speak. Earnings is one worry. Is there anything else that's a risk to this market's bull run resuming?
I don't think about the market in terms of is it a bull run or is it a bear run. I think to me, the bigger issue is what's the kind of outlook we have for growth. I think the great thing for India at this point of time is macro stability is fantastic. But, in terms of being to accelerate to a 7.5% growth, I don't see that visibility as yet because I think we are still in a very difficult global environment, though our macro platform is stable. What we could benefit from, but that's only the capital side of the equation, is once the dust settles, I think the outlook for capital flows into EMs and into India would improve. And I don't mean FPI money. I mean even eventually FDI money, which I think is really very, very important to the country's long-term growth trajectory.
All right, Vetri, great perspective as always. Thank you very much for joining in. So optimism, but laced with a bit of caution, and that never hurts, right? Thank you so much for joining us this morning.